all Australian. But the question is, what's going to happen in the future? The future's unknown. What puts us in the best position to cope with anything?
I don't know if this question is useful for others, but I also have a bias towards Australian shares. And I keep thinking about adding international share funds, but I could be wrong, but I sort of feel that these people that manage international shares, they sort of come and go. They have a number of good years, and then they, you look at platinum even, there doesn't seem to be a lot of consistency, and then on top of that, I've got to pay quite a lot of fees for it. I mean, that's.
Yeah, no, look, I got old and boring very early, and I have a considerable amount of index funds. In fact, I think all my international exposure is index style funds. For those reasons, the return's reliable, the fees are low, it's tax efficient. There are more, the ETFs that are trading now that have just been introduced. ETFs, exchange traded funds. So they're like index style. So they're like an index fund is a whole of market fund. So if it might be based on a world index that has 1,000 companies, it'll have part of all those 1,000 companies. It'll just coverage the average return from that sector. And so it's very low cost because they're not researching, they're not trading much. It's pretty, generally pretty tax effective. And so we've had index funds, and now we seem to get more of these that are listed on the stock exchange and still mirror the performance. So, but the points about fees and the predictability of returns, which we call persistence in kind of the area of study, there's a lot of evidence that there's not a great deal of persistence. Fund managers do well for a while and not for another period.
Since I'm here. Scott, the implication seems to be that you set this up and then you go away, and every 6 months you come back and balance it. Now, I think we're probably more active investors than that in this room. So if you're willing to actually spend some time working on your portfolio, does that change the philosophy in any way?
I see that's something that might be happening within asset classes. In a general sense, like for example, you might say, I did get old and boring early, and there's no way you're going to use an index fund for Australian shares, and you might use that 400,000 and make a more active approach to manage that part of the capital, or even global shares. I mean, it's not that hard. I mean, it is another step of complexity, both in terms of research but also in tax implications to invest directly in global shares. But it might be something you take on. Yeah, I would see this more as the asset allocation, the overall framework of the portfolio, and people change it. So another thing people might say is, look, I want to be more active in Australian shares. I think I can, for some reason, I think I can add value. I have information that other market participants don't have, and I'm going to trade on that or be more active on that. And therefore, I'm going to allocate less to global and property securities and more to Australian shares. I think it can be built to whatever situation you're looking for.
Figures, which are out to 4 decimal points.
Yeah.
Where did they actually come? How do you correlate fixed interest being 0.25 with Australian equities being 1?
Yeah. So 2 places where they came to. The first that I emphasised, I mentioned on the run but didn't emphasise enough. This is for data between the period 1st July 1990 to 30th of June 2007. But the question was, how are those figures calculated? And particularly, given they're to 4 decimal places, and there's a suggestion of a great deal of information if they go to 4 decimal places. What they do is, the calculation will line up month by month, generally, the returns from each asset class. So, all the Australian share returns versus all, for example, international listed property returns. And the calculation basically looks at how similar are those returns over time. To what extent are they similar to each other? So a highly correlated one, it'll have returns on a month-by-month basis that's very similar. uncorrelated ones will look quite different. And there's a statistical formula that underpins, as to how they actually come up with that figure between one being exactly correlated and negative one having exactly uncorrelated returns. So that's how they do it. They take it month by month through the time series, and then the calculations based on that.
Any further questions for Scott? If not, I think we might wrap it up there, Scott.
Yeah.
Give us a few extra minutes.